All right. Today is Monday, July 25th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. And before we start, in case you haven't checked it out already, I released a video earlier today, earnings reviews for last week. It was a good discussion, but a lot of you say that you cannot see the video for some reason, as YouTube is hiding it, whatever it is. Maybe because I talked smack about Google in that video, but give it a shot, check it out. Maybe it's working right now. Let me know in the comments. But for this video, we got a good one, because a lot of things happened after the bell. So let's not waste any more time, and here it is, in focus tonight. The Walmart disaster. We already knew that it was hitting off a cliff, but it got a lot worse. Here's the breaking news that we got after the bell. Take a look.
All right, welcome back to Overtime. We told you just before the break, Walmart has cut its guidance, and you can see the stock is reacting quite negatively to that announcement, down more than 6%. Cerity Partners' Jim Lebenthal joining us to discuss NXPI and the earnings. But let's react to this first, Jim. This is...
And I'm going to skip over this Jim guy because he's absolutely clueless. But CNBC has a reporter who knows a lot about retail. She covers it. So let's hear what she has to say.
Yeah, I have to say, actually, Scott, I'm a little bit surprised that Walmart did this mainly because we don't normally hear from them intra-quarter. So that does, of course, suggest that these changes happen potentially very, very swiftly, even though we all understood what was going on with the pressures of inflation. And I think you make a good point that the mix is really what's important here. So it looks like their comp sales are trending higher than expected, about 6%, but it's because it's a heavier mix of food and consumables, and those are lower margin goods. So the sales of general merchandise, it looks like they're sort of taking down the expectations there for the full year, even though they say that some back to school does look pretty good here, at least in the early going. It's probably not enough to move the needle. They talk about the impact of food inflation. So yes, the profit is being lowered, the lower profit for the full year because of what's going on here in the second quarter, even though it looks like revenues and comps are higher than expected because of what is being sold. So to your point earlier, Scott, sort of the wrong mix of the wrong stuff at the wrong time, and just really tough to turn around these inventory orders for a retailer as large as Walmart that does have all of these different categories at any given time to meet this waxing and waning of supply and demand.
And of course, in the post-market, Walmart crashed. Last time I checked, by about 10%. The largest retailer in the country, down over 10% in a single day. Unbelievable. This is the booming economy, right? The kabooming economy. But rest assured, somebody knew ahead of time that Walmart will crash after the bell, and they did buy. This is perhaps the dumbest insider trade that I have ever seen in my life. And the reason is they made it so obvious, like you got to be a child to believe that this is a coincidence. In the last hour of the day, they bought about $1 million worth of the 130 puts on Walmart with the expiration date of this Friday. You're moron. If you're gonna do this kind of insider trading, at least choose next month expiration date. Use next week's expiration date, for the love of God. But he or she made it so obvious. But the good news is, you think the SEC is gonna do anything about this? The SEC that remains in a coma by design, by the way, or Gary Gensler, Pussycat Gensler, you think he's gonna crack the whip here? Of course not. And if you're gonna do insider trading anyways, you better be married to somebody who is in Congress, who can feed you insider information, and then you trade accordingly. Do it the legal way, for the love of God. But anyways, what the CNBC reporter was talking about in a nutshell is the following. We talked about this numerous times in this channel. You got demand, you got supply, you have equilibrium. Then the thing hits, the great panic of 2020, shutting down factories, shutting down supply lines, ports, truckers are not working anymore, etc., etc. Supply goes down. And then comes the response from the Federal Reserve, unleashing the largest tsunami for liquidity in human history. Trillions and trillions and trillions of dollars in what is now known as the cocaine operation. So what happens? Demand shoots up sky high to the moon. Stimmies all over the place. Stonks to the moon. Cryptos to the moon. Horse manure to the moon. Everything to the moon. Everybody's rich, baby. The demand goes out of whack. Everybody wants to buy cars, TVs, appliances, appliances, homes, yada, yada, yada. Now, we have a shortage in all of these things because one thing, the demand shot up out of whack. Number two, the supply is nowhere to be found. For one reason, it cannot cope with that insane demand. The other reason is we have shutdowns due to the thing. So what happens? Prices go higher, aka inflation. Here's the problem. In solving inflation, we've been saying this over and over and over again in this channel. You gotta tackle the out of whack demand, the artificially stimulated demand. That is the core of the problem. It's not a supply problem. Even if the supply goes back to equilibrium, the pre-pandemic equilibrium, it's not going to be enough to cope with this insane demand. But the geniuses in corporate America decided to assume that the insane level of demand is permanent. This is the new normal. And they decided to ramp up the supply chain according to that out of whack, unsustainable level of demand. Now, it takes a while for the supply chain to catch up. There is a lag. If you're going to order TVs and computers and appliances, let's say in mid-2021, in this case, you're Walmart, and you ordered all of these goods in mid-last year. Well, now you're getting all of these supplies and inventories. But here's the problem. Now Walmart is finding itself in the opposite problem. All of a sudden, supply shot up higher. And where is the demand that was so hot last year and the year before? Well, that demand is gone now. Why is it gone? Because the consumer has to spend more on inflation. They're spending more at the gas pump, on rents, at the grocery store, for utility bills. And they don't have the disposable income that they used to have in 2020, 2021 to spend and buy goods from Walmart. So now Walmart has all of this inventory. They paid top dollar inflationary prices to get that inventory, but the demand is not here. What does that mean? They have to eat a loss. They can hold on that inventory and hope that the demand is going to recover somehow, magically. That would be a dumb strategy. Or they can offload all of that inventory at a discount and eat the loss. And this is probably what's going to happen. And therefore, I've been saying in 2020, 2021, all of these morons splurging and paying above the asking price for a home or paying for a used car more than it was when it was new, all of this is lunacy, and good things come to those who wait. Now you can get your TV for pennies on the dollar. Now you can get the vacuum machine that you always wanted for pennies on the dollar because Walmart has to eat the loss. They have to discount these prices down until the aggregate demand kicks in and somebody picks this inventory out of their hands. And this will happen not only at Walmart, but in the cars market, in the homes market, and everything. And here's the commentary from Walmart CEO. He says that the increasing levels of food and fuel inflation are affecting how consumers spend. Oh, you think? And while we've made good progress clearing hard lines categories, apparel in Walmart US is requiring more markdown dollars. So they have a problem with apparel. All of a sudden, people don't want to buy these clothes anymore. Who needs clothes when you have to pay an arm and a leg at the pump or in rent? What does that mean? If you really need clothes, you can buy them for cheap now at Walmart because they have to offload that inventory at a loss. They have to discount it all the way till the consumer shows up again and picks it up. And folks, I made a video about Walmart and Target, the disaster that we got, 2 months ago? When they downgraded their outlook. I made a video about it, and now we got the update, and it's a lot worse. You can go back to that video and listen to what I said. Pretty much everything I said turned out to be true. But don't feel bad for the Walton family. You can feel bad for Walmart investors. You can feel bad for Walmart employees. Oh, they're certainly going to get rid of employees. You wait, because that's the next step. But when it comes to the Walton family, you cannot feel bad for them because they dumped their stock at the top last year. They've been dumping while you're buying, hoping that stocks will go to the moon. But the smarty pants, the insiders, the oligarchs, the criminals, they know that this is a Ponzi scheme, the stock market, and they're going to use it to their advantage. They love bubbles. They love when the mom and pops participate in the stock market because they know the retail investor, when they stampede buying stocks, it becomes a casino. They create asset bubbles, and the rich ends up winning at the end. They dump at the top, locking up all these gains, and the retail mom and pop end up holding the bag. For example, S. Robson Walton. This is the big Walton. Well, guess what? You don't have to feel bad for him because last year he dumped about $7.3 billion worth of Walmart stock. This year so far, Mr. Walton dumped about $184 million worth of stock. So obviously he's smiling. He doesn't give a shit. And his sibling, Alice Walton, also got the same package. Last year, she dumped about $7.3 billion. And so far this year, she dumped about $183 million. And then we got Jim Walton, who's probably the black sheep of the family because he did not get the same package. In 2021, he dumped about $6.8 billion worth of shares. This year so far, he dumped about $183 million. There you go. This is the Ponzi scheme we call the stock market. If you're not careful, you're going to be eaten alive. But it's not just Walmart, folks. This is the economy collapsing. This is the economy crumbling and imploding. For example, today we got the Chicago Fed's National Activity Index, and it held at minus 0.19 in June. This is the first back-to-back negative reading since the pandemic started in 2020. Is this the booming economy with back-to-back negative readings in the Chicago National Fed Activity Index? You better wake up now. And then we got another disaster today from Weber. They got rid of the CEO, they got rid of the dividend, they cut the outlook down, and then on top of that, they warned of upcoming wave of layoffs. Yep, they're getting rid of employees. This is the same problem, folks. Everybody splurged in buying grills in 2020, 2021. They ordered a lot of those. They paid top dollar for this supply. Now they have the supply, but the demand is nowhere to be found. So if you're smart and you waited, you can get that grill for pennies in the dollar right now. And if you wait a little more, they're probably going to give it to you for free because they have to get rid of excess inventories. But you tell me that this is not going to be replicated across the economy when you have companies that assume that the insane level of demand, the out-of-whack level of demand in 2020, 2021 is sustainable, is the new normal. Well, now they're finding out that it is not the new normal, and they're finding it out the hard way. But the point being here is the layoffs are coming. When you got a retailer like Walmart, for example, having to sell inventories at a loss, well, their margins are going to go down. Their profits will go down. The next step for management is capital preservation. What does that mean? The easiest way you can reduce your expenses as a company is to get rid of excess employees. That excess demand that we got in 2020, 2021 produced excess employees to respond to that demand. Well, now Walmart will find itself overstaffed. They have to get rid of these employees. Are you telling me that a recession is not around the corner? The hell is wrong with you? But rest assured, you got allies. If you're a denier, if you're a recession denier, and you say, hey, what recession? The economy is booming. Look at the jobs market. Well, your ally is transitory Elon, who says that signs of a U.S. recession are not in sight for now. And I say, Mrs. Yellen, you better get a new eye exam, or better yet, resign. Resign in shame. Because I remember last year, on May 27th, when you said that high inflation rates to be temporary, aka transitory. Well, how's that working out for you? But rest assured, you and Janet Yellen, if you happen to be a recession denier, you guys are not alone. And by the way, if you are a recession denier, you were probably an inflation denier. So you got a pristine record, of course. But now you got the White House on your side. The White House is now an inflation denier. They released a statement today. What is a recession? We know that we have an upcoming GDP reading on Wednesday, or Thursday. And the assumption is, according to the Atlanta Fed, it will be another negative GDP reading. Now, the cooks at the census and the Department of Labor will give it their best shot to give us a positive GDP reading. But what if they fail? What if they put too many onions or maybe a little too much salt? And we get the actual reading, a negative GDP reading. Everybody's going to go out and say, oh, here we go. Breaking news, the headlines. The economy is now officially in a recession, ladies and gentlemen. And of course, this will reflect badly on the administration, so they want to get ahead of it. And today they set out their top propagandists from the BlackRock administration, Dees, Yellen, Bernstein, all of them. And they came out and said, oh, the technical definition of a recession is not really 2 quarters in a row of negative GDP. That's the old school one. It's not applicable right now. You got to look at other things. What other things? Like Walmart, like Weber, like the upcoming tsunami of layoffs. But this administration, folks, they're masters in propaganda. All they do is propaganda or brainwashing, as if this is the 1950s. With no respect at all to the intellect of the American people. Not just when it comes to the economy and inflation and a recession, but also when it came to the thing. They said, oh, if you take the jab, you'll be good to go. You don't have to worry about anything at all. And if you said anything to the contrary, like, hey, maybe the jabs don't really prevent the spread. They'll ban you, they'll censor you. They'll call you a denier and many other ugly words. They want you to be fired from your job. But all along, they knew that you were right. But they had to lie. They had to do propaganda because otherwise the public will not respond and take the jab if they knew it will not stop the spread. And it goes on and on and on. With the war in Ukraine, similar story. You think we're stupid? We don't know what's going on here? But this is the deep state oligarchy, ladies and gentlemen. They own the media. They own social media, the big tech oligarchy, and they can spread whatever they want, all the lies, the propaganda, with no regard at all. And if you counter any of that, or you're doing misinformation, we're going to ban you, we're going to censor you. You see how this works? I've been living in this country since I was 18 years old. I have never seen it this tyrannical. Never. But it gets even better, the denial, not just when it comes to the economy, but even when it comes to the market. You have a lot of geniuses right now telling investors that we have the bottom. The bottom is in. You gotta buy. This is a generational buying opportunity. Meanwhile, we have a recession around the corner. Yes, the stock market tends to bottom before the economy tends to top before the economy. We know that. But we are a long way till the stock market bottom happens. Yet you have Ed Yardeni, for example, who's supposed to be better than that because he's actually smart, but he has to channel his inner Jim Cramer and call the bottom because these crooks have to talk their books. They don't make money if you and I are not buying stocks. And today, Ed Yardeni said that this is the bottom. The S&P 500 already bottomed. There is no hard landing. And just a reminder, this is what Ed Yardeni said back in January of this year. Yep, you guessed it. He called the bottom. Take a look.
You're making some really definitive statements about what you think investors should do with their stock portfolio. So let's try to do it. You think we've hit a capitulation low in the S&P on Monday at what, Monday. 42 and change?
And change, yeah, 42.22.
So no further big downdrafts, no Grantham 45% loss of your principal, or not even a bear market in the S&P.
I think it was a capitulation bottom, but if it falls below that, you'll have to have me on the show again, and I'll capitulate and say, I'm kind of concerned.
That's your strategy.
And then in March, he said that stagflation could actually be good for stocks. Take a look.
Our halftime headliner today, Ed Yardeni, is the president of Yardeni Research. He's back with us once again. It's nice to see you. Ed, I was looking at your note that you put out today, and I was wondering what happened to the Ed Yardeni of March 7th when he said this. I want you to listen to this. Sure. Let's watch it, and then we can talk on the other side.
Sure. Since the war, I think stagflation is the scenario that's probably most descriptive of what we're starting to see and what we'll see in the next several months, which is higher inflation than we thought before the war and slower economic growth.
But now what happened to that guy? Because you were worried about stagflation. Today, our conclusion is that it's still a bull market and that you see 5,000 to 6,000 of the S&P next year.
Yeah, stagflation isn't necessarily bearish for the stock market.
And folks, I told you from the get-go, stop listening to all of these pumpers, Yardeni, Jim Cramer, Goldman Sachs, JP Morgan, Tom Lee. Stop listening to all of these crooks and stick with Dr. Doom and Gloom, Dr. Rubini. I told you that in a video because he's going to be right. And listen to what he said today.
What is the old world view of this recession, this slowdown that we're in, where maybe it's a mega threat, as your new book is called? This new world, it's all going to be fine, is off the mark.
Well, now the consensus view is becoming that hard landing is likely as opposed to a soft landing. But now people say, well, be short, shallow, mild, plain vanilla, garden variety. I beg to disagree. I think there are many reasons why we're going to have a severe recession and a severe debt and financial crisis. Debt ratios are at historically high, 420% of GDP in advanced economies and rising. Lots of zombie corporation, household, government, financial institutions were bailed out during COVID. This time around, we're tightening monetary policy. During the 70s, we had stagflation, but debt ratios were low. After the GFC, we had a debt crisis, but the inflation was falling, deflation, because it was a demand shock and you had a credit crunch. This time we have stagflationary negative aggregate supply shocks, and debt ratios that are historically high. And in previous recession, like the last two, we had massive monetary and fiscal easing. This time around, we're going to go in recession by tightening monetary policy with no fiscal space. So the idea is going to be short and shallow. It's totally delusional.
He's absolutely right. It is delusional to think that we're going to have a soft landing. Really, after all of this money printing, after breaking all economic rules, For years, you think the chickens are not going to come home to roost? You think we're going to get out of this unscathed? No consequences at all? Think again. And by the way, I don't say this to scare you. Your goal right now is to maximize your returns from the stock market by being absolutely diligent with your work, with your trades. Stick with pockets in the stock market that are working, that will work in a recessionary environment, and let go of pockets that are not going to work. Likewise, trade accordingly. When the stock market becomes really, really oversold, you're going to see short covering. You're going to see pops. Specifically in what? In the tech names, in the overvalued names. So invest and trade accordingly and accumulate as much wealth as you can so you can be prepared when the worst happens. Likewise, if you have outstanding credit card debt, for the love of God, pay that down. If you have a mortgage or rent that you cannot really afford if you lose your job, take care of that before it's too late. Get rid of any obligations that you cannot really afford. Start building a nest egg of, let's say, 6 to 9 months worth of savings of your monthly expenses, your rent, your grocery store bills, your utilities, what you paid the pump. Figure out what you pay per month and ask yourself a question. Do I have a savings of this amount for 9 months to come? In case I lose my job, I don't have to become homeless. Now is the time to prepare. Brace for impact. You don't wait for the impact to happen and then you start to scramble and say, oh my God, turns out the car that I'm leasing right now, I cannot really afford that. Turns out my rent is way beyond my means. Turns out the mortgage that I have, I cannot really afford, etc., etc., etc. Now is the time to think about all of that, specifically paying down your credit card debt. That's the number one thing you should be doing right now. And with that, folks, let's move on to cover the stock market information. And let's start with the performance of the indices today. And here we go. The Dow Industrial Average closing in the green by 90.75 points, or a gain of 0.28%. The Nasdaq actually closing in the red, down by 51.45 points, or a decline of 0.43%. The S&P in the green by 5.21 points, or a gain of 0.13%. The sector's performances led by, you guessed it, value/inflationary, energy at number 1, capturing the gold medal, at number 2 for the silver, materials, number 3 for the bronze, utilities. Meanwhile, the laggards of the day led by technology and consumer cyclicals, the risk-on sectors. They're not performing right now, but maybe Papa Jerome can fix all of that on Wednesday. Anyhow, the advance to decline ratios, NYSE 63% advancing versus 33% declining. The Nasdaq 45% advancing versus 50% declining. Moving on to commodities. It was an excellent day for energy commodities. Crude, the WTI and Brent both up for the day by almost 2% apiece. Gasoline, RBOB, moving significantly higher today, massive gains of almost 4.25%. Heating oil also rebounding higher and gaining about 1.5%. And then we have the party boy, natural gas, adding to the gains by scoring about 5% today. Here is some energy news for you and perhaps the driver behind the rise in natural gas once again. Now, if you think the rise in U.S. natural gas is stunning, wait till you see what's going on in European natural gas prices, because they popped higher again today by about 10%, and they will continue to move higher. Why? Because Russia is now playing games. Russia has the advantage, and we're seeing the stage of the war, not on the ground, but the economic stage of this war, where Russia is now punishing Germany. You chose U.S. over Russia when we were providing you with cheap, reliable gas. Let's see how the Americans are going to help you out right now. This is what Putin is saying to Germany, and Germany is paying the price. Not just Germany, but the entire continent, because natural gas trades on the open market. Whether you're Germany or not, you got to pay the price. Back to the commodities, futures, what's going on here in softs. The decline in lumber continues to go on. It lost about 3% today. Lumber is now trading at around $550. Likewise, sugar is down. It lost about 2.25% today. OJ was down modestly, so was cotton futures. On the other hand, the gainers of the day, led by cocoa futures, gaining about 3.25%. And then we have coffee futures also scoring gains of a little over 1%. Metals, what's going on here? Down day for both gold and silver. Even though the dollar was down, we're not going to have a clear direction one way or the other until we get the Fed out of the way and we see what the final reaction of the US dollar really is. Platinum, copper, palladium were flattish for the day, be it platinum and copper in the green. On the other hand, palladium was actually in the downside for about 0.5 percentage point. Meats, muted action for live cattle futures, yet feeder cattle and lean hogs futures down for the day. Lean hogs lost around 2% today. Grains, this is not how they closed. This is it. Mostly in the green. and the gains were led by soybean meal, scoring gains of about 4.5% today. But we also saw corn, soybeans, wheat, even rough rice all rebounding higher. On the other hand, oats futures were the laggards of the day, closing pretty much flattish. Moving on to the big casino, the options market. What's going on here? The volume disappeared all of a sudden, no volume, and they're buying more puts, folks. So that gives you a hint about the sustainability of the rebound, at least for now. Regardless, the hottest table at the casino today was Tesla, the souffle, at around 830,000 contracts traded today. About 47% of those were calls. They're buying more puts than calls. Apple at number 2 at around 700,000 contracts traded today. About 42% of those were calls. So again, they're buying more puts than calls on Apple, and I did the same, by the way. I bought some puts today. Although I might close them before earnings, yet I have another strategy that I can discuss with you later on. But here it is at number 3, Amazon at around 500,000 contracts traded today. About 46% of those were calls. Moving on to the unusual activities that took place in the options market today, we start with the ticker XLE. This is the energy ETF. Somebody's betting for more downside to come. They bought the $70 puts with the expiration date August 26, with the expectations that the name could move down by more than 5% by then. And this is a wide spread, but they paid around $2 a piece to enter this trade, all in all spending about $2 million. And then we have the ticker MCD for McDonald's. Somebody bought calls here, betting for a rebound. They bought the 265 calls for the expiration date, July 29th, meaning this Friday, with expectations that McDonald's could move higher by more than 6% by then. They paid around 40 cents a piece to enter this trade, all in all spending around $280,000. Now, perhaps the trader was betting for an oversold rebound in MCD. This is the 30 minutes chart, and as you can see from the RSI, it got really oversold, right at support. The risk versus reward says you're going to get a rebound. So they probably bought these calls and closed them the same day. Continuing with the interesting trades, what about the ticker MAR for Marriott? Somebody's betting for an upcoming downside for this name, more pain to come. They bought the 140 puts for the expiration date, August 19th, with the expectations that the name could move down by more than 8.5% by then. They paid around $2.50 a piece to enter this trade, all in all spending around $1.2 million. What about the ticker SPY for the S&P 500? Somebody bought puts, the 365 puts for the expiration date, September 2nd, with expectations that the SPY could move down by more than 8% by then. They paid around $3 a piece to enter this trade, all in all spending around $1 million. And lastly, at the bottom of the table, what about the ticker MSFT Microsoft? Maybe it is oversold, at least in the weekly charts. Maybe a rebound is coming. This is at least according to this trader, who bought the 285 calls for the expiration date, September 2nd, with expectations that Microsoft could pop higher by more than 10% by then. They paid around $2 a piece to enter this trade, all in all spending around $600,000. Moving on to the heat map analysis. What's going on here? What's working today is value. Be it in financials, be it in healthcare, be it in industrials, railroads, the defense contractors, even the farming equipments, Caterpillar, Deere, all lining up green. Likewise, the defensives, also in value, utilities, real estate, the inflationary trade, in agricultural names, fertilizers, Mosaic, Nutrien, ADM, all higher for the day, along with energy, another inflationary sector under value. Likewise, defensives, the consumer staples, Procter & Gamble, Coca-Cola, all in the green. These are all under value. These are all under risk off. So the market moved from risk on to risk off. How do we know that? We talked about value and defensives being in the green along with inflationary trade, but we also have technology down, chips down, software down, the cyclicals down, the reopening names are down. What does that say? The market has shifted from risk on last week to risk off, at least so far this week. Why? Because everybody's waiting for Jerome Powell. And most importantly, not just the decision. We know it's going to be 75 basis points. If it is 100 basis points, that would be a negative surprise. But the market is waiting, most importantly, for the guidance. It is waiting for what Jerome Powell is going to say about September and beyond. Is it going to be 75? Then the Fed goes to sleep in August, comes back in September, does another 50 or 25, and that's it. Then we will see the shift back to risk on. You will see technology, chips, software, cyclicals moving higher, while the defensives, risk off, the value trade being dumped again. Now let's talk about corporate news, and we start with the ticker NEM, New Mount Gold, a stock that I used to own in my portfolio, not anymore, because gold prices went down by a lot. On the other hand, the expenses for these companies, they continue to rack up. And today we got exactly that from New Amount. They missed on the estimates. The cost went higher by 23% year over year. On the other hand, gold prices are down. So this is a really bad environment for gold miners. Now, if the dollar tops after Jerome Powell and we see gold moving higher again, maybe picking the dip in some of these gold miners is not a bad idea. But it all depends whether the dollar topped or not, whether gold bottomed or not. We're gonna know after the Fed on Wednesday. Next, we have news for the WWE. The stock shot up higher, almost double digits today. It remains one of the top performers year to date in the stock market. And now we have the news that Vince McMahon is out. Apparently, they disclosed a $14.6 million in payments in hush money. He's been paying women that he allegedly harassed. So he probably doesn't want all of these skeletons to come out. Retirement is the answer. The new CEO, Stephanie McMahon, nothing is going to change here. If anything, the business is still hot. But the speculation for now is maybe that Vince McMahon is out of the way, his kids, Stephanie and the rest, will sell the company. If that is the case, you will see the stock of WWE shooting up significantly higher. Because if they do sell it, it's going to be for over $5 billion. A lot more than that. So expect this stock to be hot in the options market now that we have speculations of the company being sold. And remember Boeing, the flying coffin, it was one of the hottest stocks in the last couple of weeks due to a short squeeze. Well, now we have bad news and the stock actually went down today because we have about 2,500 workers of Boeing on a strike right now after rejecting a contract offer. That means more wage inflation in Boeing. That means more expenses, and we know that the revenues are trash. At least for now. Bad dynamic for Boeing. The name is reporting earnings this week. We'll see what happens. And then we have more corporate welfare, this time around for GM. We talked about the chip industry getting a gift of about $52 billion, courtesy of the taxpayer. Now we have the taxpayer giving GM $2.5 billion to build EV batteries. Do we get anything in return of that? Do we get cheaper access to EVs from GM for funding their investment? Of course not. You see how this Ponzi works? You work hard, you pay taxes, then the government takes that money and spread it around to the oligarchs, to the donors, the corporations, and you got nothing to say about that. Go back to work, bum. Make more money for us. And lastly, what about Tesla? We have this bombshell story that alleges that Elon Musk, Reverend Elon, did indeed bang Mr. Google's wife, Sergey Brin. No pregnancy at the time of this reporting, not that I'm aware of, but Mr. Google divorced his wife, and apparently the relationship between him and Musk really soured, to the point where Sergey Brin instructed his advisors to sell his personal investments in Elon Musk's companies after learning that he had a brief affair with the Google co-founder's wife, according to the Wall Street Journal. And apparently, once again, Elon Musk reportedly dropped to his knees and begged for forgiveness after his affair with Google co-founder Sergey Brin's wife. Now, this story is a little complicated here because we have a love triangle, but it gets even better. Mr. Google's wife, or ex-wife I should say, well, her name is Nicole Shanahan, and turns out she's a piece of shit too, just so you know. Before Shanahan and Brin met at a yoga retreat in 2015, Shanahan was married, the finance executive. So apparently she cheated on her ex-husband with Mr. Google. And just a word of advice, if she cheats once, she's gonna cheat again. You genius. Likewise, when a girl, for example, says, oh, my boyfriend, my husband cheated on me, and then decides to take him back, because he explained, his dick just magically fell into her vagina. And he really regretted, and he said that he did not mean it. It didn't mean anything. He's not in love, blah, blah, blah. And she takes him back. Well, guess what? He's going to cheat on you again, you moron. It's called a habit. But anyhow, despite her reported initial struggles to become pregnant, the couple welcomed a daughter in 2018. Whoops. Now we're going to do the DNA test to make sure that this is not Elon's kid. Shanahan spoke about her fertility struggles in an emotional speech at a launch of the Center for Female... Well, anyways. But I can already imagine that Elon Musk approached her and said, I heard that you have some fertility struggles. Maybe I can solve that. But it's not just Elon Musk who's creepy. Apparently the whole family is nuts. Elon Musk's dad, this is Papa Musk, well, he says that his sperm is in high demand and he is willing to donate to high-class women only. You gotta be high class. Otherwise, by high class, by the way, he means hot and young. Otherwise, he's not interested. And perhaps the Musk family need to concentrate less on donating sperm and repopulating the planet and concentrate more on the souffle itself. Because, here's the headline, Tesla gets a second SEC subpoena over Musk's 2018 Go Private tweet. They're coming for him. That Twitter lawsuit, That will be the end of Elon Musk, the beginning of the end. And it gets even better. Now the SEC is coming after him. Wait till the Justice Department comes after him. Wait till the story that comes out when Elon Musk thought that she's 18, turns out she was 14, and she got pregnant, and you know what's going to happen. That's coming. Anyhow, moving on to the heat map for the ETFs. What's going on here? Green across the board for the most part, with exception of what? The risk on growth. We're talking about the cyclicals, the XRT for retail, chips, SMH, technology, XLK. All of these are lagging. And value is outperforming. The IWD, the VTV leading the gains. That happens to be in the backs of energy, the XOP, OIH, XLE, materials, the XME. In financials, even the KRE participated today, but even the defensives, XLU, popped higher. Every time we have risk off, XLU moves higher. Commodities gained a lot today, specifically the natural gas ETFs, UNG, BOIL, all closing with massive gains for the day. When it comes to international, all in the green, but leading the gains, the commodities giant, the EWZ for Brazil. We've anticipated that, by the way, in this channel, that we will see a rebound in the EWZ as commodities prices perhaps catch a bottom. But all of that depends on what Papa Jerome is going to do on Wednesday. Moving on to charts, let's start with the SPY, the S&P 500. What's going on here? The chart went down today all the way back to the support 393.16, and it formed what it appears to be a double bottom for now. And the bulls would argue this is going to play out, and we will see the SPY cracking above the resistance of 398 once and for all. But remember, the bears are going to counter and say until that happens, this could be a formation of a head and shoulder, meaning sooner or later the chart will lose 393.16 as support, and it's going to flush down all the way to the next support at 385 or even below to close the gap. We'll see who's right. It all depends on what the Fed's going to say. Here's the continuous contract for the SPY, the S&P 500 daily chart. What's going on here? Any damage from today's activities? Not at all. If anything, the chart is consolidating in a bullish pattern, a bull flag pattern. It is keeping the support at around 3,960. So far, so good. It is not making any lower lows. It is not losing any important support. The volume is not shooting up higher. The momentum indicators remain bullish for now. All of these are signs that the bulls are in charge. That doesn't mean that the bears are not waiting around the corner and lurking around, waiting for what? Waiting for a slip from Jerome Powell that will be the equivalent of a green light to attack the stock market and flush all of these charts down. What about the Qs? The NASDAQ 30 minutes chart, what's going on here? Similar story. The problem is with the Qs, it made lower lows, but it's not a problem in the grand scheme of things because the support of 297.5 is intact for now, and the bulls would argue that this is a move down to gather some energy to crack above the resistance above in yellow that we talked about in the previous video once and for all. But it all depends on the fundamental driver, the catalyst that will initiate either the pop above the resistance or the crack below the important support of 297.5. We have two catalysts this week. Number one, the Fed, the most important one. Number two, earnings, specifically from Apple. Apple is the make or break it kind of stock in this market. If it delivers and the Fed delivers, higher we go for the rest of the summer. If they don't, we have lower lows to come. Here's the daily chart for the continuous contract for the Qs. Any damage here? Not at all. The support is intact at around 12,207. No problems here. The chart is consolidating in a bull flag pattern, waiting and waiting till the aftermath of the Fed meeting. Now, if we have a pattern of lower lows, if we see support lines being broken, then we got a problem. But for now, we don't have any of that. The volume is below average. The momentum indicators remain positive. All of that tells us that the bulls remain in charge. The IWM 30 minutes chart, what's going on here? Within range, the support remains at 172.60. The resistance, we talked about it before, it's a previous gap, but for now, we don't have any update here. The chart remains within range. Although, when we look at the RSI, the MACD, it appears that the negative momentum is about to end and the chart is about to start new positive momentum, which means the IWM could crack above the resistance, let's say tomorrow. Yet I doubt that any major move will happen before the Fed on Wednesday. The dollar index, what's going on here? This look is a little scary because the dollar is not giving up ground. It might have put in a short-term top for now, but it is waiting and waiting for the Fed to slip, for Jerome Powell to say something that could be perceived as hawkish to pop again. And if it does pop again, say goodbye for the bounce of the stock market. It's over. So the dollar should be moving down. Why isn't it moving down? It is waiting for the Fed. It has the energy it needs to pop higher. Otherwise, it would have flushed down. The dollar says, I have another leg higher in me, but I need the Fed to initiate that. If the Fed doesn't, then lower I go. But if the Fed does, watch out, we have another pop higher in the dollar. And if that happens, it's not going to be good news for gold. For now, gold did rebound from 1,685. It is consolidating. It is waiting for more clarity from the Fed whether to pop higher or not. That all depends on the performance of the US dollar. When we look at the momentum indicators for gold, they're all oversold. They're firming up again. So the risk versus reward says gold pops higher, the dollar takes another leg down. But that depends on Jerome Powell being dovish. What about Brent? Crude oil, 4 hours chart, what's going on here? It is still facing a stiff resistance at around 105.84. Whether it's going to make it or not, that also, spoiler alert, depends on Powell. For now, oil bulls will argue that this could be a reverse head and shoulder formation. And whatever Powell says, it doesn't matter. We will see a pop higher in crude once again. That pushes inflation expectations higher. That pushes interest rate hikes expectations higher. Not a good outlook for the stock market, if it does happen. Now, what about the daily chart for the US 10-year yield? What's going on here? No update, still holding ground. It is within range. The support at around 2.72, the resistance at around 3%. No major moves here until the Fed is out of the way. Likewise, the TLT weekly chart moving accordingly. Technically speaking, the technicals say higher we go. In the TLT, it became really oversold. We should see a short covering / oversold rally. But it all depends on the Fed once again, folks. The Fed will make or break this chart. For now, there's nothing to see here. Here's a 4 hours chart for the VIX. What's going on? We got another pop above 24.29 that was met with failure. But look at the MACD indicator from a 4 hours perspective. It is showing green impressions on the histogram. We are seeing what it appears to be a bull flag pattern on the VIX. Does that mean that the VIX could gather the energy and pop higher, cracking above 24.29 once and for all? That could be the case. If it is, we could see weakness in the SPY ahead of the Fed meeting. And this is actually what the bulls should be hoping for. Weakness ahead of the Fed meeting. Go in bruised, beaten, with all of the bad news, and then Papa Jerome comes to the rescue. But if the market goes in, all high in the sky, massive gains, stocks shooting up higher, no worries at all, the risk for a disappointment becomes highly likely. Here's the VXN. What's going on here from a 4 hours perspective? No update. Nothing is going on here. Consolidation. The MACD indicator still negative, not showing us any sign whatsoever that we have positive momentum in the VXN, which equals to negative momentum in the Qs, at least not for now. Things could happen tomorrow, but specifically after Apple reports earnings on Thursday. Speaking of, here it is, Apple, a daily chart. It stopped exactly at the trend line. It is pulling back. It got a little ahead of itself. The bulls actually should hope that Apple will go into the the earnings report below 150, better yet below 145, because the risk versus reward says even if the report is not that good, we could see a pop in Apple after earnings. But if Apple heads into the report overextended in the technicals and the RSI and the MACD, gaining double digits ahead of the earnings report, the risk for the disappointment becomes highly likely, even if the report is not really that bad. This is the psychology that you have to understand. Tesla, 30 minutes chart, what's going on here? It went all the way down to the next support at around 802.41, and it closed right there pretty much. If that is lost, we have support at around 766.5, and then we have the gap, but we'll take it one day at a time. For now, this could be a process of gathering energy, meaning the folks who bought at 700, 720, be it short covering or be it market maker buying to cover for a gamma squeeze, doesn't matter. They're now booking some profits, not the shorts of course, but the market maker, and it got the chart all the way down to 802.41. Now, if we have new blood waiting on the sidelines saying, you know what, I missed on this massive pop from, let's say, 730 all the way to 840, and now the chart's trading at around 800, I'm not going to get a better deal than this, and these folks start buying the stock, we will see a pop higher above the resistance at around 825.25. Otherwise, the chart goes down. And lastly, Bitcoin, what's going on here in tulips? The positive trend now became negative. The positive trend talking about higher lows. Now we're talking about lower lows. And until that ends from a support level, preferably above 20,000, this is a negative trend. And this negative trend will accelerate if the chart indeed loses 20,000 as support, because it is an important psychological level. A lot of folks, once they see Bitcoin below 20,000 once again, they will assume the worst. We will see a flood of sellers showing up. This will take the chart down. But for now, the positive rebound, that's over, at least for now, because the series of higher lows ended. Until that restarts, the chart remains in negative trend. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the S&P Case-Shiller National Home Price Index, and then we have the Consumer Confidence Index. We also have new home sales. What about the earnings calendar? An important day, we have 3M, Raytheon, GM, Coca-Cola, Mondelez, Chipotle, Alphabet, Visa, and Microsoft. Lots of action, folks. Buckle up your seat belts. But for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Take this. Now I gotta turn my back.